Selling your business is one of the largest financial events of your life. For many entrepreneurs, it represents decades of work, risk, and sacrifice to finally turn your business into a liquid asset. But there's a trap we see all the time. An owner spends years building an incredible company, negotiates a great sales price, and then discovers they're going to send a massive portion of the proceeds to the IRS. Not because the tax code forced it, but because the planning started too late. Before we get started, I'm John Moriarty, co-founder and managing partner at E3 Wealth. We focus on helping business owners think strategically about taxes, liquidity events, and long-term wealth planning. And one of the most expensive mistakes we see entrepreneurs making is waiting until a letter of intent, or LOI, to begin thinking about tax planning. Because by that point, many of the most powerful strategies are already off the table. When a buyer submits a letter of intent, the clock starts moving quickly. You're negotiating terms. Due diligence begins. Attorneys and investment bankers are engaged. But structurally, most of the important decisions about your financial life have already been made. Your entity structure is in place. Your personal balance sheet is already built. Your real estate ownership is already established. And once the transaction process begins, there's often very little time to restructure anything in a meaningful way. That's why it is a better idea to start your exit planning earlier. For most business owners, the optimal planning window is around 3 to 5 years before a potential sale. That runway allows you to address several structural decisions that can dramatically affect the outcome. For example, should the operating business and the real estate it sits on be separated? Many owners discover too late that selling both together may create an unnecessary larger taxable event. Another example is entity structure. Certain restructuring strategies require time to implement properly and to satisfy IRS requirements before a transaction occurs. Once a deal is imminent, those opportunities may disappear. Exit planning also intersects with your personal financial strategy. For example, if a large liquidity event is coming, it may make sense to think about Roth IRA conversion planning in the years leading up to the sale. Why? Because after the transaction, your income may spike dramatically for a period of time. Those higher income withdrawals can close the window for lower tax conversions that would otherwise have been available earlier. In other words, the years before the sale can sometimes be the latest and last opportunity to reposition certain assets more efficiently. There's also the question of what happens after a liquidity event. Many entrepreneurs focus entirely on negotiating the purchase price. But from a financial standpoint, the more important question may be, how will that income be structured? Will proceeds be received all at once? Will there be an installment period? Will there be ongoing compensation or consulting income? The way that those income streams are layered can dramatically affect your tax outcome over time. And those decisions are much easier to design before the transaction process begins. The key insight here is simple. Exit planning is not transactional strategy. It's a long-term wealth strategy. It's about coordinating your business structure, your personal balance sheet, your tax strategy, and your long-term retirement planning, and doing all of that years before the sale actually occurs. Because when the LOI arrives, the deal terms are being negotiated, but the tax outcome is often already determined. If you're an entrepreneur who believes a liquidity event could happen in the next 3 to 5 years, this is about the time to start thinking strategically about the structure of that outcome. The earlier the planning begins, the more options tend to exist, and the difference in outcomes can be significant. If you'd like to explore how this type of planning might apply to your situation, we invite you to schedule a conversation with our team. Because when it comes to selling a business, the goal isn't just optimizing the sales price, it's optimizing what you actually keep after the transaction is completed.